In recent years, the housing market has attracted considerable attention due to its rapid growth and rising prices, leading many to wonder if a housing crash might be on the horizon. Understanding the signs that could indicate a shift in the market is essential for both homeowners and investors. In this video, we will examine 3 critical warning signs suggesting a potential downturn in the housing sector. First, let's consider the issue of affordability. Housing prices across the globe have soared, but wages for the average worker have not kept pace. This growing gap between income and home prices has pushed affordability to strained limits. When potential buyers find themselves priced out of the market, demand naturally decreases. Historically, such conditions have preceded significant downturns. Economists are keenly observing the balance or imbalance between price and purchasing power, as it could signal an impending correction. Next, we turn our attention to rising interest rates. Central banks worldwide are adjusting interest rates in response to economic pressures such as inflation. When rates go up, borrowing costs increase. Higher mortgage rates mean that monthly payments become more expensive for buyers, further straining affordability. The ripple effect is a cooling demand in the housing market, as fewer people qualify for loans or are willing to purchase homes under these conditions. If interest rates continue to climb, it could dampen the real estate market and potentially trigger a decline. Lastly, watchful eyes are on inventory levels. During recent years, there has been a shortage of housing supply, which has driven prices upwards. However, there are indications that more properties are entering the market, which could lead to an excess of supply if demand falls due to the aforementioned factors. An increase in inventory, with fewer buyers, contributes to longer sale times and could lead to price reductions. Historically, excessive inventory has been a hallmark of market shifts, often preceding significant corrections. In conclusion, while the prospect of a housing crash might not be guaranteed, these 3 warning signs, housing affordability, rising interest rates, and increased inventory, are critical indicators to watch. By carefully analyzing these factors, stakeholders can better anticipate and potentially mitigate the risks of a market downturn. It is always prudent to stay informed and prepared for any eventualities in the market. As we continue to navigate these dynamic economic times, remaining vigilant is the best approach to understanding and adapting to changes that may lie ahead.